Greetings, market rebels. Welcome to this week's sector situation. It is Sunday, September 4th, 2023. It's a little bit after 11:30 a.m. here on the East Coast. I'm going to get things rolling because I've been having some tech problems and probably need to get through this quickly. Whatever the case, just another day in tech paradise. Here's our trusty disclaimer. Here's a trusty intellectual property rights notice. If you can have a look at that. And then finally, here is our macro measure stream for the week. And again, things are really tough to evaluate, I think, for me at least, properly without understanding the context of things. And so that I include that just in case you did not catch the you don't catch the macro measure, or you just want reminders on things. So with that, what I think I'm going to do is switch our share. So just bear with me, please, and we should be able to get back to a different screen, and that screen should be screen 3, and that should give us, yep, our grid of 12 sectors that we usually start off with. And there's a lot of basic, I guess, comments we can make this week. Remember, the idea was that hopefully we'd be in a bull market, and we'd be able to start to see sectors that had their moves and sort of had run their course, and then find other sectors that were emerging. But it's really become more about, because of the market we've been in since really the end of 21, start of 22, it's really been more about some of that, but really also about the health of the market, right? And what's concerning, what's starting to pop up that could be concerning at times. And so we did kind of note that the last couple of weeks that certain things we're finally starting to recognize reality as we see it, right? Where how are they maintaining this levitation for as long as they did in the face of rates? That's really been the big talk for me, at least. I've been harping on that now for, I guess it's close to 20 months since I started right at the start of 22. But you could see, just looking at some of the RSIs that are on here, that a lot of sectors really did finally get hit in a big way, and they got worked down towards oversold or very close to technically being oversold. But as I often say, something that's sold at 31 on the RSI, that's close enough for me. Something like this that's at 34, it's close enough for me as well, right? It doesn't have to get to 30 for me to say, oh yeah, wait, that's finally oversold. It's very close, and that's, in the greater scheme, I think that's what matters. So what I would note, though, probably this week is that it became obviously a risk-off week, and some of the sectors that we had noted that they look potentially challenging, like XLI, we had an idea in there. Things that were hanging in there, sort of, I think, better than I really thought they should have. Just maybe a few weeks ago, they finally really have started to, I think, catch down to where they should have been. I was just kind of using that macro news rate situation, and then just the world economic developments in key countries. It just didn't make sense for me to see these things really, XLI really up there, with rates doing their thing as well. So that is definitely oversold. The basic materials are now oversold. The transports, which I think are very important, which we sort of use a little bit of a canary in a coal mine, they are definitely oversold now. And financials, which I was waiting for, another, for me at least, important sector, they started to catch down to reality too, and they're approaching oversold. Key sectors like XLRE are now also oversold. We've been waiting for this and XHB to finally give up the ghost, and they finally started to. It's been a while. I don't think we were alone. I think there were so many people probably looking at it that way that helped keep this sort of artificially high for maybe longer than it should have been. But even these defensive sectors like XLP can be a little bit, and XLV, the healthcare space, they also came under pressure finally. And so things have just really gone into risk off. Even, right, XLE, the mighty XLE, which has been doing really well. That, again, I think that I mentioned that it got a little bit towards the overbought area, and I think we did see paper show up in there that could have been a hedge, for sure. But we saw a lot of put buying in XLE, and that finally was there for that pullback. And so that was probably just due. I would say as long as it holds on, that is still probably one of your better looking sectors. But certainly it looked better before last week's carnage. That had a rough week. The other thing that's interesting too is the former leadership sectors like XLK and XLC. These really haven't cracked to the extent that others have. And so what I would say with respect to that is if these start to crack big, they have a lot of room to go, right? As does SMH in my book. So if they let those go, then they fall. That could really lead to that visit that I talked about to the 200-day in the SPX or SPY. That could produce that, and maybe you get an overshoot. And remember, that's in accordance with the third year of the presidential cycle, like we talked about in macro measure, that what we've seen so far in September argues for more of a general weaker finish in September and a rough October, but there could be a relief rally sprinkled in as we start or end SEP and start OC. So it's a tricky phase because of all these various factors, and also the seasonality, the cyclical nature of things that we see in this third year of the presidential cycle around this time. So I don't think it's easy right now. I think you have to still be really strapped in there and ready to trade nimbly. It's just because you could even just see it here. You're getting oversold, not everywhere, but in many, many places. And what happens next. If they're in the absence of more bad news, right, or rates going, that's really the key thing, rates in my mind going higher, they will probably try to at least engineer a bounce, right, soon. Not maybe Monday morning, but I would say at some point this upcoming week, or at least the start of next week, there is going to be more than likely an attempt to bounce if we remain oversold. And then especially, I think, if rates start to come back down a little, and I don't think it's out of the question for rates to come back down. So we did see deterioration everywhere. I do think there's some things that you should be concerned about. I'll leave it on XHB because we're here. But you can see on XHB, and this is one that had us a little befuddled, would be one way to put it, where how is this thing holding out in the face of these rising rates? But they finally came around for this thing. It did finally come down a lot more. It still, I think, could come down further before it's all over for sure. And I think that 200-day right there would be a spot where that could happen. So that would be just a general overall target. But remember, right now, the RSI is already at 32 on that. So again, that the gang trying to maybe open weekly, put something together from there, and then maybe having more trouble is certainly something that's crossed my mind. But XHB to me this has taken a real turn. You got the lower high put in, lower low put in. There's the makings, obviously, of an intermediate term trend change at this point. So it's why is it tricky? Because you're almost oversold, but not really super oversold in this and in the market. So you got to wait. Maybe we'll see a little bit longer, and then I think there will be a bounce attempt. But the larger point on that, though, along with XLRE for me, is that these are critical areas: commercial real estate, housing. Some people will argue that housing is 2/3 of the U.S. economy, that it can be explained by the housing market. And so the housing market finally cracking, right, or at least XHB cracking, not a good sign. Commercial real estate cracking, maybe a worse sign, in some ways, because this could create some problems in terms of the system, right? A credit event, as some would call it. This could show up here. It's been talked about for years how there could be a really serious credit situation. You don't like to see a situation where you lose this intermediate term trend when you were in the channel. You can't fight your way back into the channel. You get smacked down by all the SMAs that are now above it. All of those are pretty much downtrending at this point, and they're mainly stacked from shortest to longest overall, not quite to a T, but that's the general view right now when we look at the moving average complexions. And I'm not big on these things, but that's just something worth noting. That is not right the kind of look you want to see if you're a bull. So I think there's two really vulnerable areas there. That is not good. I think a lot of it, of course, has to do with what's happening right with mortgage rates and home prices. I probably have beaten this a little too much in terms of a dead horse, but I just think it's sort of like this to me is focusing on this stuff is exactly what it means to keep your eye on the ball. Because if you can say that 2/3 of the U.S. economy is dependent upon that real estate situation, and that especially the home construction and that the housing market, and that's seizing up due to extremely high home prices relative to folks' incomes, and of course the extremely difficult mortgage payments that are many are faced with now at these with these rates and high prices. So that to me is not good. But do note, right, that every time we've seen a real pop in rates, there's at least right a little bit of a pullback. So you could see that it's not like these things like it really runs out of control relentlessly. There's usually some kind of a pullback that follows a good pop, and we just had a good pop. So I can't say that we're done, that we can't go higher. Of course, I'm just saying you got to be on the lookout. I would watch this. I would watch the dollar and see how things are reacting to them. And that's really going to be help you guide a lot of your decision making. A lot of people, I don't think, do these things, and they kind of focus when they're newer, especially on their one individual stock or two individual stocks that they're in. But if you're more of a swing trader looking to ride things for hours to days and maybe even a little bit longer at times, you got to see how things are reacting in the big picture, and especially to rates, because they've been so important for so many reasons for so long. I think it's the most important factor, really, when people say, well, what should I do with my money? Right? Should I invest in this, that, or the other thing? Well, I can get this much with a supposedly risk-free return. Well, why would I take on a lot more risk for 1% more? That kind of a comparative comparison. So that's pretty much the core of what we do, I think, in this type of system that we're operating in. But anyway, there's your TNX, and it's definitely powered up, and it's created the trouble for the market we thought it could if it did do this, right? So this has been a long time coming, finally did it, and now it could back up a little bit more, and then we have to see how it reacts, right? When it gets back towards this level, should it trade back down towards these highs a little bit, then you can see if it holds there and starts to go again or not. So that's that. Now let's take a look at XAU, since we're kind of on this topic of rates and the dollar and so on and so forth. And as I said, I have reluctantly put some bullish ideas in UOA Pro lately, and even UOA Essential. We had one this week because we really had some gold, really strong hits in there in terms of size. And with the dollar moving up like this and rates moving up, I really had a hard time believing that this is really going to pop. But you just don't know when there's something that could be geopolitical or something kind of scary about the financial system that could develop. And so I try not to let my own take completely overwhelm what I do that way. And you could see a little bit, I think the charts were looking a little bit better this week when we added a potential idea in there, but you could see it just couldn't fire. And like I've been saying, I still don't think that this is out of the woods yet in terms of the bigger picture charts and maybe having more trouble. So that in that space. So that's what I wanted to mention there. I'll go over to our energy area. Let's take a look at the energy area. And as we noted, XLE had a rough week. It was probably due, right? If you go back and look at where we had peaked out at, you get an RSI reading right near 69. And so that's, not technically overbought, but certainly for me, it's overbought enough, right, that I'm a little concerned about it when it gets that way. Oil futures, they were hanging in there a little bit better than oil stocks. But again, the correlation is pretty solid over the course of time, but there are times where things do diverge. And this did finish out better on the week, didn't have as rough of a week overall, but it did back up a little bit. So that bears watching. But Still at 66 on the RSI. We'll have to wait and see what happens there. Thinkorswim switched me, I just noticed, to percentages, like it does to me sometimes. Come on, get rid of that. But yeah, so this, they're both saying like, okay, a little bit of a pullback. Now we have to see, right? I think you may as well look at this low here at 88.37. If you can't hold 88, you're probably on your way down to test these other SMAs like the light blue 20 and the golden 50 right there. Now let's take a look at related. I should have done this when we were talking about housing, but I had other things I wanted to cover and skipped over it. But we've been looking at wood and cut, these ETFs, kind of to say, are they confirming the weakness in housing? And you can see they had a rough finish to the week. And you would, I mean, other than the specific market dynamics that exist that are unique to these, right, with lumber, timber, you would expect overall that they would have a rough finish, the way that rates have jumped and what the Fed had to say, and right, how housing itself is looking a little challenged. So that all makes sense. The oil makes sense. We've also from time to time looked at copper, try to get a beat on what's going on in the global economy. We did see this sort of, it's been very, right, it's not a big mover. B, right, it's been range bound, and that took a turn for the worse too, right? So this was looking a little bit better as we came into last week, and that just ended poorly. So not a good finish, right? You're getting close to where you break down a little further, you're looking at challenging some maybe key lows. It might be the low for the year. Let's find out. We'll go back a year in time and see. And yeah, this is really, it looks like it's the 2023 low there. So not really that wonderful, right? Not all that good. Not looking good below virtually all your SMAs. Many of those are down sloping, maybe with the exception of the 200 there in purple. Maybe that's just flatlining. But yeah, so anyway, not a really great look there. Trying to think of what else I could cover for us that we typically get to. Oh, SMH, I definitely wanted to highlight. I don't even know how I almost forgot about that. But this to me is, again, this is a big deal. And I'll look probably at XLK and XLC because they've also been able to weather the storm fairly well. But I'm back on percentages. So I would say, look, somehow the bulls are barely clinging to a little bit of control here in a big picture way. But I would say, look, if this month ends poorly, not that we couldn't then get a relief rally. I think you could get a relief rally attempt. Certainly, if this upcoming week is ugly, yeah, I think there's definitely a chance you'll get a relief rally. But I don't think that the month ending poorly helps bulls out overall. I think it creates even more trouble for them. Technically speaking, they'd have to do more work to really resuscitate the recent glory days here. And I don't think that would be easy, right? If that sort of spell of AI really has worn off. So just keep that in mind. But this to me, right, you're getting down there on RSI. You're at 30, whatever it is right now, 34. You were at 31 and change on Thursday. They managed to pull something off here. I don't know exactly what they did, but this gap is very obvious. And a lot of people could be waiting for that to close, but the 200 days a little bit above that gap close there in purple. There is another prominent gap way back here. If we overshoot and really go into a major sell-off, that of course could happen. But right now I'm looking at lower high, lower low. Not good, not a good look on the intermediate term. And really, I think your pullback into this 200 I've been saying this for a couple of weeks. I think that makes a lot of sense in a way. So don't know if you fully get to there. Maybe you overshoot it, but you're out of the channel. You broke down below the support line of that channel. That to me is looking pretty challenged. And this has been a really big area. Again, I think it's a leadership area you've got to keep your eyes on. And it's really been the reason the chip stocks jamming with the AI hype has really been what's made this, I think, market mirage of wonderfulness that's made that possible. If you remove all that from it, as some people have noted, you really have a rough time. And in fact, NASDAQ breadth is not very good overall. So it's really poor, actually. So without some of these big leadership stocks, they're really the only things that are left. And you know what they are in terms of SMH. But the same thing could really be said with, like, Google and Meta in your communications. And if those things start to give up the ghost, then there's a problem. And it looks like there's still a gap back in here from April, and that's way down there. So I do think that there's potential here. This is still hanging in there. I think the XLC hanging in above the 100 there in dash white is okay. But if it starts to take that out, I think a lot of people are going to start realizing we may be trapped. Not that they are trapped, but I think I've been saying this for a long time. I think a lot of people could then reflect upon what happened here and say, geez, rates stayed up a lot higher than I expected for a year longer than I expected. Why did I commit so much capital to this? And I think a lot of people did. I think there are potentially a lot of trapped bulls. And if they start to have this change of heart, right, because they're forced to, because things are really selling off, that could really obviously exacerbate the situation. And you could get a really serious sell-off, right? Something more than what we've seen so far. There's the gap in XLK. So I think if we do go further risk off, you can see what levels. That's really all near the 200-day, generally speaking, in XLK, XLC. The XLK names are your big tech names. So yeah, this is a problem. And if they give it up, especially SMH with NVIDIA and AMD and some of the other ones like Avgo, they start giving it up, Broadcom, in other words, Broadcom, then that could be the end of the bloom from that rose. And the leadership really cratering is something that would be disheartening for a lot of these players. But again, that could lead to an opportunity, right? And it could be an opportunity if it starts to happen. It could also lead to a nice tradable low, given the third year of the presidential cycle, seasonality, cyclicality, and what that leads to in the fourth year. Typically not my thing. I think things are pretty darn challenged. I'm kind of like, how are they going to pull this off? Really more of a skeptic on that, but you have to acknowledge that over the course of time, it plays out quite frequently that way. And that's why you've even got those biases that people cite at certain points in the cycle. It just happens. So it might be inexplicable, but it'll potentially still happen. So that's the thing. But so I guess on that, I'm going to wrap it up. I think you can see that we did go to risk off. I don't think there's any question about that. Some of these really important sectors got walloped. Finally, like discretionary even got smacked down. There's a gap in that one too. But remember, a lot of things are oversold. So again, we're approaching oversold. That's why we're at a tricky juncture. You're not completely bombed out in this market, but you're also fairly close to where we've seen some sort of a rally unfold from, right? In terms of your overall levels in oversoldness, the way breadth has gotten rocked. So if I had to throw any kind of a guess out there, I would say if the bulls were smart, they should have a little bit of early weakness, get this stuff really overdone a little bit more to the downside, and for maybe a day and a half or something like that, and then start to work on their relief rally that they maybe try to save the month from being as visually dire as it would appear, I think, on some of your bigger picture charts. And that could create more negativity going forward. So I think it would be a lot easier for them to stick to the third presidential year cycle that ends on a very good note from the second half of no really through deck. If they prevent more serious carnage soon, that helps them rather than trying to immediately rally. I think if they try to immediately rally, that might set them up for the second half of the week ugliness. And if you get that, then again, that makes those monthly candles look a little bit worse by finishing that poorly. So if I'm them, I get the ugliness out of the way early and I finish on a better note. And then we do see that often early October is rally material in this third year. So that's what I would say is the ideal scenario for bulls. Get the weakness going Monday, maybe let it persist a little bit on Tuesday. And then if you see that it's letting up a little bit, then try to finish the week on a positive note by ramping from there into the close of September. So I'm going to wrap it up on that note. I hope something that I share with you helps you out this week or in the future. I'm going to try to bring these in on less time somehow, macro, measure, and sector situation. Got to figure that out still. But yeah, it's just not what it doesn't seem like this longer term discussion type approach is something that folks care to engage with, I guess would be a way to put it. So on that note, everyone have a great finish to your weekend and a great upcoming week. Thanks for tuning in.